I want to thank everybody for joining us today. Obviously, we'd prefer to be doing this in person. I know many of you have attended our event in the past out at Lockkeepers. And obviously with COVID and the situation from a safety standpoint, we felt that moving it to a virtual format was the best way to go. And as I think about, 2020, go back to January and what a year it's been. I don't know if anyone would have seen everything that's happened, that's transpired, or could have been able to predict it. We've had a global pandemic. We've had a stock market collapse unlike anything that we've necessarily seen before. The month of March, we had 2 of the 5 worst days ever in the history of the stock market on a percentage basis. We've had businesses close. We've had businesses reopen. We've had civil unrest in our country. Oh, by the way, we have a presidential election coming up in under a month with early voting underway. So it's been a crazy year to say the least, but I think it's a great time for this type of update. We've got 3 really good speakers you should see on the panelists there. We've got, starting on the right, we've got Josh Hemmert, who's going to go first here in a minute, from JP Morgan. We've got Dean Mioli from SEI, and then we have David Lentz from Schneider Smelt Speets Bell. Hopefully, David, I pronounced that correctly, or you could correct me when with the proper name when you get up to speak. But we've got 3 great speakers. I want to first bring up. I asked Josh to do a economic overview, economic update, and I'm going to have him walk through some slides from the Guide to the Markets, which many of you have heard Josh present before. Is one of the best, if not the best, exhibits that's out there as far as different market updates. And I think they even update that on a daily basis. Now they used to do it quarterly and then monthly. So if we could just advance the slide here. If I could move that. There we go. Oh, yeah. So just to kind of lay this out, too, real quick. So the opening remarks, here are the presentations. We will have time for question and answers afterwards. Everybody on your screen, there should be a Q&A box you should see. If you want to type a question in, all we would ask is if you could send it to all panelists, even if it's a question for one of the 3 speakers individually. If we could get it to all panelists, that would be great, and that way at the end I can kind of moderate the Q&A, and we will save all the questions for the end. So with that, again, here's Josh's bio up there. Josh actually spent some time in Ohio, went to school at Ohio University, and again, I'm going to turn this over to him and have him walk through his presentation.
For dialing in, I guess it's a little unique this time around. I think it's the 3rd year I've been in front of the group here, and the first virtually. So it seems like every conversation these days is virtual in nature. But I hope everyone is doing well. I hope your families are doing well. Certainly a very unique setup this year. So we're going to cover it all. I think John did a fantastic job just kind of laying out some of the dynamics that we've seen year to date in what has been a pretty intense year, to say the least, so far. Just in terms of a very high-level construct for the agenda here in the next 15 minutes or so, I want to hit certainly the virus and some of the thoughts that we have from that angle. And I think that'll lead in well to the volatility that we've seen across markets, the reaction or market action that we've seen generally over the year-to-date period, the environment today, right? So as we look across the economic landscape, what are some of the things that we're cluing into? And then finally, everyone's favorite topic, or perhaps your least favorite topic, the election coming up here very soon. So with that, let's jump straight into the content and get going here. So I think it's really tough to start anywhere other than this picture here and what's happened with COVID-19 and just how much of a global challenge we've seen, given what's happened. 3 key things that I would say, when it comes to this conversation. First is you can't downplay the human component, right? I mean, the loss of life, when you look at this illustration, the visuals in front of you here, whether it's the number of cases, but but certainly the fatalities, just how much this has impacted what that global picture has looked like. I think if there's a positive to take away, it is that you are, in our view, seeing improvement here at the margin. So one example of this would be if you look at the left-hand side of the page, which is that daily increase in cases, and it's a 7-day moving average over time. You'll see that an area like Europe, which is in that purple line, had seen that initial run higher in the number of cases and then kind of ebbed lower. And you can look at the right-hand side of the page, that same purple line again, just the challenge in terms of what that meant for people that had a unfortunate outcome in terms of that initial spike in cases. But then again, now more recently, we've seen this rise in cases again, if you look at that purple line in Europe, but yet fatalities are nowhere near the type of environment that we saw before. So I think there is a positive in the sense that whether it's therapeutics, other things that we've learned on the medical side, there is the ability at the margin here to improve what outcomes look like for people. But I think this also is very much hand in hand with the second component that I would put forward, and that is that it's not over, right? I think that's certainly a sentiment that everyone would probably share and echo that's listening in here this afternoon. But when you look at Europe again, just the idea that you're seeing this second spike, and we're seeing some of the beginnings of that in other places across the globe as well. This is something that we're going to be living with for quite some time to come, potentially. A positive, though, in that is that we believe, given that you don't see as much stress on the healthcare system as what we did in the first bout, you see those better health outcomes. We think that we avoid sort of those uniform lockdowns that we've seen across the globe in the early innings of COVID-19 when we looked at the first quarter of this year. I also think that it links over to just this general sense of uncertainty in terms of businesses, when you look at individuals, and when we try to think about things from an economic perspective, and really tough to kind of segment between the two, of course, but when you try to think about it in terms of the impact to markets, that is an element that we'll continue to watch as we think about things going forward. Just in terms of kind of taking that forward a little bit here, you'll see on this page just what that meant in terms of economic recessions this time around relative to what we've seen historically. So this picture here shows just how much we turned off the economy overnight here in the U.S. And this is a similar picture if you looked outside the U.S. as well. But this data is focused in here on the domestic landscape and the environments that we've seen year to date. And you'll see that on the bottom right-hand side of this picture. So this visual is showing two things. The first item is the length of U.S. recessions historically, and that is on the vertical axis here. So how long is a given recession that we've experienced? So each one of these bubbles represents a recession over our history here in the U.S. And then the second component that we're showing on the page is the severity of those recessions, right? So the bigger the bubble, the bigger the drawdown, the bigger the recession that we've seen. And I think maybe just two instances, two recessions to point to put the recession that we've seen year to date in context. And if you looked all the way up on the top left-hand side of this page, that largest bubble on the page is the Great Depression. Right? So you saw nearly a 27% decline in economic activity, real GDP here in the U.S. And I think very notably, very, very different from this instance, you saw the length of that recession, that depression back then lasted almost 4 years in terms of the timeline. This time around, very, very different. Bottom right-hand side of the page, a 10% drawdown in economic activity. But I think the biggest difference is certainly just the length of time that it's played out here. So, when we look at the data, we certainly entered a recession in sort of late first quarter, beginning of second quarter, depending upon how you want to cut the data. Again, though, very, very different this time around in the sense of how short that recessionary environment is, and I'll get into that in a little bit more depth here. So on the next picture, to show that a little bit further, and this also just pulls into that that component of market volatility. So two components on this page. You'll see market volatility on the bottom, and this is looking at equity markets here in the U.S., so the S&P 500 as representative of an equity index. And you'll see this jagged line going all the way back to 2010. The volatility as you move to the bottom right of this page spikes dramatically higher, right? And that is the stress that we saw in late February, but particularly March, as March moved along. And it's not on the slide here in front of you, but if you actually captured back to 2008, 2009, the great financial crisis, we actually saw volatility this time around exceed the levels back then, right? So that just kind of puts in context, hopefully, how high volatility has been and how high volatility was in the first quarter of this year. And unfortunately, when volatility shoots higher, that typically is an environment where equity markets, risk assets, things like credit securities, so corporate bonds, but certainly stock prices have a very challenging time. So the top half of this page shows the S&P 500, the equity market, and you'll see that sharp move lower in terms of what we saw with equity prices as the first quarter moved along here in the U.S. And again, certainly something that happened from a global perspective as well. I think what's certainly notable, though, is, again, sort of the shortest, sharpest recession that we've ever seen on record here, but it was also kind of ... followed by the quickest snapback that we've also ever seen on record, right? So not just that dramatic, sharp decline in equity prices, which was nearly 34 percentage points lower on the S&P 500, but then you see that sharp move higher. And, when we look at some of the key components and what has been driving that as the second quarter got along and we've continued on throughout the year, that's where I wanted to spend a few minutes in terms of the key elements that we've talked about across our team here. So the first key foundation has certainly been what we've seen from fiscal support, right? So this is those in government that have really provided a lifeline in a very, very challenging environment. And one big component of that, in our view, was or has been the CARES Act. I think in an environment where it's very difficult to find instances where you see bipartisan support or bipartisan coordination across government in recent years and recent decades, this is one that I think has been very notable in the very early days of the pandemic here in the U.S. with the CARES Act. So the Senate vote for this act was 96-0 in terms of being passed. We viewed that as a recognition in the sense that this is a very, very challenging environment. Support was going to be needed, and that support was very much coming through in the early days of COVID-19. This entailed stimulus checks, of course, that I'm sure many people received. This also, as a key component, incorporated a number of elements on the unemployment side. So if you really look at some of those key elements, it was expanding the number of people that were eligible for unemployment. So gig workers, for instance, if you're an Uber driver or a Lyft driver, for instance, you could now file for unemployment before you would not be included in that potential unemployment mix. It also elongated the timeline in which people could draw benefits, unemployment benefits, and it also substantially increased the benefit that someone was experiencing, right? So all of these things, oftentimes, and I think there are certainly a number of media stories written about this and across financial media and media generally, many people were ultimately earning more being unemployed in this period versus sort of the income that they had before COVID-19 appeared. This has certainly meant higher deficits here in the U.S. and some of the data on the right-hand side of this illustration or this page will show you that. It certainly means that we have higher debt loads here in the U.S. and this is a picture that, again, when you look outside the U.S. is very similar. But that goes hand in hand with the idea that we're in an environment, we've been in an environment where that fiscal support, that support from policymakers has been really important and, in our view, one of the kind of shining lights coming through in a very difficult time for many, many people. Of course, I'm sure many people are aware that these benefits ended on the 31st of July. There's a lot of back and forth these days in terms of what that additional support may look like at the margin. Unfortunately, I think some of that very likely may be a post-election conversation as we continue forward, but in our view, that's going to be a continual important piece as we think about the landscape moving forward for asset markets and for the support generally for individuals across the economy. The second very important component is, again, policy support. This time, though, moving over from government officials, Republicans, Democrats, more so to the Federal Reserve and other central banks, similar central banks when you look across the globe. And there are a whole range of factors that came into the mix as the pandemic escalated. The first item that the Federal Reserve did is they quickly lowered interest rates, and this is the right-hand side of the page here. And what they did, the one interest rate that they control, it's called the federal funds rate. They lowered that down to 0, and they did so in a very quick fashion. This is essentially trying to make borrowing more affordable for individuals. This typically links over to other interest rates when you look across the economy. So one example today, if anyone has looked at mortgage rates more recently or auto loan rates, for instance, those rates have come down in a marked fashion relative to what we were seeing last year or even at the beginning of this year. And the way that we see this is not just in terms of the Federal Reserve here in the U.S., but on the right-hand side of this page, those gray bars would be cuts, lowering of interest rates across both developed market economies, so economies like the U.S. or Europe, but also emerging market economies as well. And the takeaway is that gray bar is much, much higher on the page, all the way to the right, relative to the blue bar, central banks that are hiking interest rates that are making it more costly to borrow at the margin, right? So the Federal Reserve is helping in terms of making loans more affordable in a very difficult environment. That's been very important. It's also been a whole host of other components as well. So on the left-hand side of this page, for the last 10 plus years is a phrase that's gotten a lot of attention, quantitative easing. The Federal Reserve announced unlimited quantitative easing as the pandemic moved along here, and some of the amounts that we've done this time around have absolutely been jaw-dropping in nature relative to not just the size, but the pace in which they were done coming out of the great financial crisis. And you can see this on the left-hand side of this page as that orange line and as those various colors shoot higher as 2020 has continued along, right? So this is the Federal Reserve and other central banks being very, very supportive in terms of markets across the board. The last item, which isn't on the page in front of you, but we think has been a very seismic change in terms of that support as well from the Federal Reserve, has been their willingness to buy corporate credit, right? So think about the bonds of a Ford here in the U.S. Or an AT&T, other corporations. They expressed a willingness to step in and say, we will be the buyers of those bonds. We will help support this market and keep, again, borrowing costs affordable for companies in an environment where, again, many sectors were completely kind of turned off in terms of revenue overnight, right? So making that a better, improved environment in a very, very challenging picture. And just to give you a sense, the day that was announced, that series of elements was announced, was March 23rd, and we don't think that it's a coincidence that the bottom, the trough that we saw in equities this year was on March 23rd, right? So that action from policymakers has been incredibly important, and the Fed has been a very, very big part of that. Moving along, one of the elements that we certainly wanted to see within our team is not just kind of this idea of policy support coming through in a big way, which was, again, very, very helpful, but making sure that also linked over to improving economic data, right? So as you're starting to see all this help come online, are you seeing people have a willingness to begin to participate again in the economy as we open back up? Are you seeing people move around to a greater extent? And the illustrations in front of you show a little bit of some of the conversation that we've had across our team. So the first element that I want to hit on is mobility data. And the best way to really talk through this is if you're on your cell phone and you have a smartphone and you're pulling up Google Maps or Apple Maps on your phone and you punch in how do I get to my nearest Target or how do I get to my nearest Walmart or pick your store, right? They have the ability. Google on the other side or Apple on the other side is seeing you and everyone else that's putting in that same query and being able to tell, as we moved along in the first quarter, that the amount of mobility, the amount of movement across the economy declined dramatically, right? So the very beginning of both of these illustrations show the middle of February, and as we went into lockdowns across many countries, many specific areas, you saw that movement across economies decline, in some cases by upwards of 90%, right? And that is, again, kind of that idea of turning off the economy overnight. From there, though, and this is the piece that I would really stress, is that as we've opened most regions back up, and as that continually has moved along over time, we've seen an improvement in the other direction off that very, very tough picture in the first quarter where mobility has increased dramatically, right? And in the case of, somewhere like Italy, for instance, or in a number of these other countries, as you look on the left-hand side for developed market economies, or on the right-hand side in emerging market economies, you've seen many instances where we've really even eclipsed, the amount of movement that we saw coming into the issues with the coronavirus. Right, so this is one element that we're looking at in terms of economic activity beginning to pick up, and the assumption that as people move around more, especially if you're looking at to retail locations, that should mean more economic activity at the margin. The next element that we've looked at in terms of some of the data has been just economic growth. Right, there are a number of ways to look at this. Here in the U.S., the government puts out a slew of economic statistics, economic data points, same picture when you look internationally as well. And the right-hand side of this page just shows how challenging economic growth has been. So the last two data points that you see on this page, the second quarter, this is the big drawdown that we experienced in terms of economic growth. So if we really went into lockdown in the tail end of February and into March, right, the first quarter wasn't as impacted, right, so it was a lower number on that negative side, but it was really the second quarter all the way to the right where you saw that big drawdown in economic activity. The tough thing about that is that the frequency of that data point only comes to us each quarter, right, so it's a little bit lagged and it doesn't pick up some of that inflection that we've seen in economies beginning to open up. So one of the things that we've looked at, in addition to that mobility data that I just went through on the previous illustration, is manufacturing and service activity, right? So on the left-hand side of this page, this is data that comes to us each month from the government here in the U.S., and what you'd see is that services, so going to the hair salon or going to your barber, or anything else in more of a service-related economy, but also manufacturing activity, which is the gray line on the page, so the building of different goods across the economy. Both of these elements, as we look across the board, have started to show market improvement. And the way to read this is anything north of 50, so anything above 50, is showing an expansionary type of activity, right? So you see this incredibly sharp move lower as, again, we shut down across the board. But very, very importantly, you've seen this inflection higher again where we're showing expansion here in recent months. And what I would want to stress to you is that markets, asset markets, typically really focus on that rate of change, right? So yes, we had a very, very difficult, challenging environment, but that rate of change was one of improvement. And that is certainly one of the elements right next to all that support that we've seen from the government and from central banks that is helping create this environment where stocks have performed incredibly well coming off the lows that we saw in late March. One last element that I would point to, and this is really what you're buying if you're buying stocks, right? You care about underlying companies across the stock market, their ability to generate earnings, right? That's essentially what you're buying as you're buying stocks or equities. And when we look at company earnings, this is the S&P 500, so focused in, again, on the U.S. And when you look at earnings, everything on the left-hand side of this page, if it's a gray bar or a green bar, it's historical data, right? So it's already happened. That is kind of in the past. And what you'd see is on the left-hand side of this page, some of the last few gray bars that you're seeing are the highest that we'd experienced, right? So earnings have been very positive, very strong in recent years. And given the pandemic, the impact in terms of what that meant for companies overnight, you certainly saw earnings expectations, right? How profitable are companies going to be? It took a hit, right? And the way that we see that is looking at analyst expectations. So the light blue bars on the page show what analysts are really penciling in terms of anticipating for S&P 500 companies to produce when you look across their earnings moving forward. And you'll see that even if we're going to take a hit here in 2020, which is that first light blue bar relative to 2019, you do see this improvement that's expected as we look at the last two blue bars on the page. So 2021, 2022, this is off that belief that as you continue to see that policy support, as you continue to see economies open up, if we do have good news down the line in terms of a vaccine or, again, just the ability to have better outcomes on the health side through therapeutics and other elements that are happening there, we can really avoid those full-scale lockdowns again, and companies can perform in a very tough environment still in many ways. The other element that I think is really important and certainly comes through in what we've seen year to date within equity markets is just how different of a picture it's been depending upon the sector that you're allocating to, right? So if you look at the FANG stocks, for instance, right, those technology companies, the sectors that have really performed well, you can see on the right-hand side of the page one illustration that really depicts why we think that's been a little bit of the environment that we've seen year to date. So what you see here is at the beginning of the year, analysts' expectations for earnings growth sector by sector, right? So across the board here, you were seeing analysts have positive earnings expectations as we started the year, so before the coronavirus, for every sector in the economy. Very, very different when you look at those analyst expectations here in the middle of September, and those are the green bars here on the page, right? So the sectors of the economy that have fared much better, technology, healthcare, where it's much more dependable, or you don't actually have to have a physical location open, right? The Zooms of the world, for instance, if you've been video conferencing, or Cisco on the WebEx side here, or Google or Apple, right? We're still consuming technology and using those services on a daily basis, and in many ways in a much greater way. And that is creating an environment where the demand for those services has very much stayed afloat relative to other sectors across the board. And that has certainly driven a picture where those stocks have done much better in this climate. That has also linked over to equity valuations, right? So we saw this very difficult period for stocks, followed by this very strong environment, again, as the second quarter got underway. And, I get asked the question, we get asked the question many times a day in terms of equity valuations, or stocks expensive? And this is an illustration that would certainly say that stocks aren't cheap. And I would not be making the case today that they are cheap in any way. I would caveat that, though, and just maybe to frame what you're looking at here on the page is a price to earnings multiple, or a PE ratio, is one way to look at equity valuations. It's just one way, but it is one way that is popular in terms of what people look at. And what this chart is showing you is that for every dollar of earnings that a company is generating in the S&P 500, an equity investor, a stock investor, is willing to pay nearly $22 for that dollar of earnings. And if you look over the 25-year average, the past 25 years, on average, for every dollar of earnings, investors have been willing to pay nearly $16.50 for that dollar of earnings, right? So we are living in an environment where equity valuations have moved higher. The caveat, though, is to keep in mind that earnings are moving higher, we believe, as you continue to see that policy support continue to heal markets, as you see economies continue to come more online, like we were talking through, and that will help out what that earnings picture looks like going forward, right? So if you're paying a similar price but your earnings are improving, then that PE ratio should improve or should come down over time and be kind of less than these nosebleed type of levels that we're seeing today. We do believe that we are in kind of the early innings of a new economic cycle, a new business cycle here in the U.S., and that even though it's going to be a long period of time before we reach the type of economic activity that we were seeing pre-coronavirus, that rate of change is the element that people should be focusing on. And when you combine in all that support that we've seen for policymakers, it's a positive environment for owning things like equities and credit across a well-balanced, diversified portfolio today. One element that we've included, and just a last couple items to wrap up here. I've showed this the last 2 or 3 years that I've been in front of the group. Volatility is always with us, independent of the market environment. It goes hand in hand in being in markets, and there is no free lunch, maybe outside of participating in the annual events or the past annual events, with the Parkhurst group here. But this is one illustration to show you what that volatility has looked like historically. So if you're looking at the gray bars on this page, this is showing calendar year returns, right? So if you went to bed on the first day of the year, the first day of 2019, for instance, and you woke up on December 31st of 2019, at the end of the year, you'd see the calendar year return in the S&P 500 last year was nearly 30%, all the way on the right-hand side of this page, right, 29%. And if you look at the red dots, though, for each one of these calendar years, those are on the bottom half of the page here, right? So at some point last year, the peak to trough decline in the S&P 500 was 7%. And if you look back over every calendar year that we have on the page, even though 30 out of 40 calendar years ended positive, the average decline on any given year over the past 40 years has been nearly 14% from peak to trough at some point throughout the year, right? So we always have volatility, especially across risk assets like equities, like stocks. It's part of the price that you pay to have a higher expected return from an asset class that you're allocating to, and look no further than the year-to-date environment. Even though if you kind of went to bed on January 1st and you woke up this morning, you'd see that we've actually had a positive year-to-date environment in terms of stock prices. That peak to trough decline as of the middle of September was 34 percentage points during the first quarter, right? So volatility is always with us. We think this is just really important to try to manage those emotions that we see across investor portfolios. Try to stay diversified, try to stay balanced, pick your spots, but really try to avoid those knee-jerk reactions from being all risk on or all risk off, based upon the types of volatility or the type of volatility that we're seeing in the market environment today. And then one last item, just in terms of talking about emotion, there's probably nothing more emotional these days than the election. And I don't want to make too extreme of comments here, but at the same time, certainly something that is playing a big or having a big role in our conversations more recently. The punchline, though, is that it hasn't impacted the way that we're allocating portfolios, right? So a couple of elements that I would mention here. The top half of this page really looks at the S&P 500 again, so U.S. stock prices, and the bottom half looks at economic growth here in the U.S. And on the top half of the page, what you'd see is whether it's divided government going all the way back to the late 1940s, whether it's Republican-controlled government in the red or Democrats being in control in the blue, you would see that in each one of those instances, each one of those setups, you've seen positive annualized returns on average for markets, for equity markets, right? So, it is very difficult, I know, for people sometimes to distinguish between their, their political view and their investment view. But again, when we think about, what you're buying as an equity investor, it's really the viability of those underlying companies, the ability to generate earnings that you should really care about. And the bottom half of this page, again, right alongside stock prices, you'll see that whether it's a Republican-controlled government, Democratic-controlled government, or a divided government, you've seen, on average, positive economic growth as well, right? So certainly a lot of focus today. I think the big item from our view is that independent of whether it's, President Trump being reelected or whether it's a Biden administration going forward, we believe a critical piece is going to be that continual support that we see from policymakers, so the Federal Reserve and other central banks, but also just that fiscal support in what is continuing going to be a kind of tough environment for a lot of people that are still unemployed, for instance. And we think that that is going to be a backdrop that is with us, whether it's a Republican, White House or whether it's a Democratic White House. And we think that that is the most critical element as we think about things moving into 2021 moving forward. So just a very quick summary, from the JP Morgan view, obviously a very, very volatile year-to-date environment. But when we look across the landscape today, we think it's very different as we sit here at the beginning of October from where we were in late March. That policy support has been incredibly helpful. And, we think that as you continue to open up economies, we'll have ebbs and flows moving forward as we struggle with the virus. But at the same time, we think that things are incrementally improving, and that's the area that we're really focusing on and having a positive view as we, constructively allocate portfolios and lean into risk today across mandates and across portfolios. So let me pause there, and I'll hand it back to you, John.
Thanks, Josh. Great presentation. Really appreciate it. We'll have a few follow-up. If you can hopefully hang on, we'll have a few follow-up questions, which we'll go through at the end. I would also, too, just make a comment. We will give everybody access to these slides. I think that was one question that came in. So we will distribute the slides. We actually also, this is being recorded, and SEI, which we're very thankful for, is hosting this. We're able to use their technology. They're recording this, so assuming it makes it through all the necessary compliance, we'll have to review it and everything is discussed. I don't see there should be any problem with that. We'll also have the recording and the slides sent out, and that may take a couple weeks, but we'll get that out to everybody. So, Josh, again, thanks. Great presentation. And I'm change this over. Dean is going to be our next presenter. Many of you heard Dean speak before. We've had him out. He is a specialist in taxation, tax planning, tax advice. I think the self-proclaimed tax doctor, right, Dean, I think is your title, or maybe that was given to you by someone. But I asked Dean to walk through kind of the current tax planning environment and also some ideas for planning as we move into the fourth quarter of this year. So with that, Dean, I will turn it over to you.
Thank you, John. Good afternoon, everybody. Yeah, this is kind of a crazy time. Normally we are talking to clients in the fourth quarter when it comes to tax planning, but now on top of that, we have this election, and the two candidates have very divergent tax positions that we will cover. And certainly you want to remain flexible with your planning, but you still do need to plan. So here are the things that we'll be covering today. It's a big agenda, but we're going to work right through it. One thing that you should always be aware of and cognizant of is what tax bracket you're in. Depending on your filing status, that I'm showing you here is the 2020 U.S. tax rates. But these rates are historically low. And some of the ideas I'll be talking about will be taking advantage of these low rates. For instance, if you're married filing joint, you're in the 24% tax bracket up to $326,600 of income. That's amazing that you're only in the 24% bracket with that level of income. But if you have that level of income as a single person, you're in the 35% bracket. So a lot of tax planning is better done while you're still married and still both alive, as opposed to waiting for someone to pass on and then try to do some tax planning. But those brackets, 10, 12, 22, and 24%, are all rather low. Once you get above that, 32, 35, 37, it gets a little trickier. But you're in these lower brackets, it's an awesome time to be doing some tremendous tax planning. One thing to keep in mind right now, we are getting into the fourth quarter. A lot of mutual funds will be announcing their capital gain distributions. It's been a wild year, especially in the first quarter of this year. We do expect some capital gains to be paid out of mutual funds. Of course, you may have done some gain harvesting or potentially loss harvesting this year. Good time to take stock as to where you are with realized gains and losses. Though, as you can see, if you happen to be under $80,000 of taxable income filing joint, look at your long-term capital gain rate, 0. And if you're single, under $40,000, again, 0. This also applies to qualifying dividends. So, as an example, let's say your taxable income this year is $50,000 projected. You could harvest up to $30,000 of long gains, right, and still be under this number. Guess what? All your long gains will be taxed at 0% at the federal level. I love 0 as a tax rate. So when you're in these lower brackets, 10 and 12%, gain harvesting makes sense. Though when you get above that, as we'll talk about that, you're going to start wanting to tax loss harvest. And of course, in our tax managed models, whether it be using our mutual funds, exchange traded fund models, individual managers, we do tax loss harvesting on a regular continual basis. Not that we do it every day, but we're looking to do it every day. We take advantage of what the market's giving us. We try to use, as Josh mentioned, the volatility strategically. Of course, if you do have gains this so far, so you might want to look over your portfolio to see if you can take some losses. We try to wipe out our gains with our losses, and you're allowed to take actually $3,000 in excess of your gains in a given tax year. So that's kind of the magic number to get to, a minus $3,000 when you look at your Schedule D, your gains and your losses. If you can't quite get there, that's good, but make a conscious decision whether you want to gain harvest or loss harvest, and if you want to loss harvest, look over your portfolio, work with John and company, and see where you might be able to harvest those losses. There's no reason to pay tax unless you absolutely have to. That's my motto. Something to keep in mind for 2021, as you know, I'm sure John and company has told you, there are no required minimum distributions this year. But they'll be back next year. And we do have a new table coming out for required minimum distributions. It's not a game changer by any stretch, but the factor that will determine how much you take out of your IRA accounts is going down. So the amount of your RMDs in the future will be a little less than they are today. Though, well, one could consider still taking an IRA distribution this year if they wanted to. I mean, it's not required, but as I mentioned earlier, when you're looking at your tax brackets, if I can do an RMD, or it's not really an RMD, just a distribution, if I can get it taxed at the right rate, why not do it? Okay? It's hard to avoid the tax altogether, but if I'm paying at a favorable tax rate, I say do it. Okay? So something to consider. So here are the rates as they are today. Let's just focus on age 75, for instance. The factor here, 22.9. Next year goes to 24.6. So a little change. Again, not going to be a super material for most of you out there, but it'll be a little bit better going forward. All right, let's get into some itemized deduction planning. The stats just came out for the 2018 tax filing year, and it's amazing how many people are no longer itemizing. Over 90% of Americans do not itemize their deductions. You have to be a little bit more strategic with your itemized deductions if you're looking to actually benefit from them. And what we see as the real fulcrum of whether you will itemize or not is really your charitable deductions. And the reason why is this. One is most people do not get a medical expense deduction. You have to hurdle 7.5% of your adjusted gross income. And if, let's say your adjusted gross income was $100,000, you would need $7,500 in medical expense above what insurance would cover. And most people have insurance of some type. So it's really rare to see a medical expense deduction. State and local tax is limited to $10,000. Can't take more than that. So you may or may not have a mortgage, which is certainly deductible. There's no more miscellaneous itemized deductions. That's gone. So the real determination of where you're going to probably itemize or not is going to be your charitable giving. Let's talk about that. The two things that we see people give typically are cash gifts, okay, and appreciated securities. Now, there is a special rule for this year as part of the CARES Act around charitable giving. And if you give cash directly to the charity, to your local church, your synagogue, the United Way, the Red Cross, directly to charity, cash, you can actually deduct 100% up to your adjusted gross income. So in my example, if your adjusted gross income is $100,000, you could give $100,000 this year and deduct a whole $100,000. Normally, it's a 60% AGI limitation, adjusted gross income limitation. This year, for cash contributions direct to charity, it's 100%. So if you're really looking to reduce your income this year, for instance, let's say you did some gain harvesting, maybe you panicked a little bit in March and sold some things at a gain. Now you're saying, well, geez, I got to have this big tax bill. What can I do? Well, here's one thing you could do is try to wipe out some of those gains with a charitable contribution, okay? Another gift you can give to charity would be appreciated securities. And we've had very good markets over the last 10 years or so. Look at last year, almost 30% return. This year, maybe not as much, but nonetheless, we're still up pretty big over the last 10 years. And one way to deal with those gains is to give them away to charity. So instead of selling something at a gain and then writing a check to charity, just give the security right to charity. Now, there is an AGI limitation to that, too. It's 30%. But, again, most people don't butt up against these limitations. So don't let that get in your way of your charitable planning. And just so you know, if you can't deduct what you give this year to charity, you have a 5-year carry forward, a 5-year carry forward. So if you can't do it this year, you can do it next year, okay? Or the year after, you'll get that deduction. And we'll talk more about the Donor Advised Fund in a second. It's a great charitable giving vessel that you can centralize all your charitable giving in, and it does come into play in some of the strategies I will be talking about. But one thing, I'll only mention it briefly, because I am a big believer of the Roth conversion, you could take advantage of the 100% deduction of cash gifts and pair that with a Roth conversion this year. Essentially, your charitable contribution would offset the Roth conversion income. And by combining tax strategies, you're really setting up a tax savings powerhouse. Now, let's talk about the Donor Advised Fund. We've seen a huge resurgence in the use of donor advised funds, not just ours, but across the United States. There's well over $100 billion in donor advised funds, okay? The nice thing about it is when you give to the Donor Advised Fund, it's a charitable donation. You get a tax deduction right now. It can accept all kinds of assets. It can accept cash, marketable securities, other things like potentially real estate, Bitcoin, all kinds of things can go into here. Of course, most of it will be sold immediately upon entry. Inside, once the money or assets are put inside the Donor Advised Fund, all growth after that is tax-free. I love the sound of tax-free. Okay, you get one tax receipt. It centralizes all your charitable planning. Much less expensive to operate than a private non-operating foundation, which is a potential choice, but normally you see operating these foundations when you have 7 figures to donate, maybe $2 or $3 million. That's not most Americans. Most Americans are giving $2,500, $5,000, $10,000, $20,000 a year. This is a much more appropriate vehicle. And it's a family asset. It's not only something that you originally contributed to, but later on your kids could be the directors of this donor advised fund and continue to make charitable gifts out of the donor advised fund. It's very simple on how it works. You, the donor, contribute cash or property to the donor advised fund. You get an immediate tax deduction right now. And then anytime in the future, whenever you want, you can make grants from your donor advised fund to your favorite charities. You can skip years. You don't have to give every year. You can let that money grow. You can have yourself, your wife, your spouse as a successor or a director now, and name your kids as successor director. So this, again, could be a family asset for a really long period of time. Well, we're seeing a lot of use with this because in an effort to itemize your deductions, you may want to clump your charitable giving into 1 year. So instead of giving, let's say, $2,500 this year, give $10,000, put it in the donor advised fund at $10,000 or $10,000 worth of appreciated securities. Get a $10,000 deduction right now, but then over the next 4 years, you can peel out your normal charitable giving, whether it's, say, $2,500 per year. This way you can potentially itemize your deductions this year, get the full benefit of your charitable contributions, and in subsequent years, you just take the standard deduction. We call that the lump and clump strategy, something you might want to consider. So, again, some great planning ideas around the donor advised fund, giving appreciated securities to the donor advised fund, the taxing you will not recognize for tax purposes. If you've had a high income year this year, for instance, if you exercise stock options, you sold a piece of real estate, you realize capital gains, and you don't have any tax loss harvesting opportunities, okay? This is a year you want to accelerate your deductions into, okay? Marry those deductions to your income. So you want to front load those charitable contributions into because they're worth more. If you're in the top bracket, 37%, each dollar you put in to the donor advised fund is 37 cents on the dollar. Makes a great sense to do that. As I mentioned, you could also pair a donor advised fund contribution with a Roth conversion. And as I mentioned also, the lump and clump strategy, accelerating deductions into 1 year so you can itemize, that's the lump, clump them into the donor advised fund. John and company can certainly help you, advise you on how to invest that money once it's in our SEI Giving Fund. That is our version of the donor advised fund, the SEI Giving Fund. $10,000 minimum. Something that I want to tee up for next year is the qualified charitable distribution. Since we didn't have RMDs this year, I wasn't so keen on doing a qualified charitable distribution. But for next year, when RMDs return, and for those of you who can itemize, because you can't get over the standard deduction, and you're over 70.5, then this is your answer, the qualified charitable distribution. Instead of taking the RMD into your own personal account, give your RMD all or part, or even more than your RMD. You're allowed to give up to $100,000 to charity directly. And it's an easy thing to do. It's just an ACH transfer from your account to your church's brokerage account. Very simple to do. You can't use the donor advised fund in this particular case. But just remember, this is a good thing to do at the beginning of the tax year because the first money out of an IRA is your RMD. And if you want to give your RMD to charity, do it in January. Okay? And in fact, if you didn't do a QCD this year, I would consider doing a double next year because you didn't have an RMD to take this year. That's great. So if you do next year, do it double your normal QCD amount, and that'll bring down your taxable income. So something to consider. And there are other benefits to the QCD because it could reduce your adjusted gross income, which in turn could help you with less of your Social Security income being taxed. It could also allow more of your, let's say, your medical expense to be deducted. Potentially, you might knock yourself out of having the 3.8% Medicare surtax applied to your investment income, which for a married couple kicks in at $250,000 of AGI, and for a single person, $200,000. So there's a lot of great benefits to the QCD. And again, no rush to do it this year, but I would certainly tee it up for January 2021 if you're interested in doing this. And it really appeals to people who are charitably inclined and over 70.5 and have an RMD requirement. All right, I want to cover estate planning just a little bit because I'm going to set up David here because he's coming up next. But let's take a look at some basic estate planning ideas. COVID really threw a wrench into everybody's plans this year. And here are your basic documents: your will, your trusts. Maybe many of you might have a revocable trust, your durable power of attorney, which is someone that's going to take over and make decisions for you if you're no longer capable of doing it yourself, your living will and your healthcare directives. Very important to look at these documents right now. One thing that has come up is that with COVID, you couldn't, if you had someone who was going to direct your healthcare, for instance, let's say you happen to contract COVID-19, you couldn't get into the hospital and talk to those doctors. They weren't allowing people that weren't sick into the hospital. But yet, if you are the person that's supposed to direct treatment for your loved ones and you couldn't speak to the doctor, well, how are you going to communicate what should be done or not be done? Normally, that required a wet signature. You had to prove these things. So the remedy here is to make sure your documents allow for remote communication. And as a last point here, it's always a good idea to continue to review beneficiaries of life insurance policies and retirement plans to make sure they're up to date and you're making all the proper considerations in your future estate plans. You can't change these from the grave, so you're going to make sure that these things are up to date and the right beneficiaries are on, especially if there's been changes in your life. For instance, if you've been divorced, people have been born, things of this nature. Make sure that these things are up to date. Now, what I show here on the left is just a historic estate exemption. You can see it has increased dramatically since 1997, and the top rate has come down. Right now, we have a top rate of 40% with an $11.5 million exemption through 2025. Then it's going to revert back to the 2017 exclusion amount, which we approximate to be about $6 million. Now, that's still a pretty big number, but there's very few Americans that have $23 million estates. Point being is, if you look at the Biden plan, he's looking to reduce the exemption by quite a bit. We're looking more of about a $3.5 million exemption as opposed to an $11.5 million exemption. So there's going to be some huge changes for upper income earners under the Biden plan, whether they'll apply to wages, all types of earned income, also additional Social Security taxes to high income earners, but also there's a big push here to change things from an estate tax perspective. Okay. And another thing that we've all as planners tried to do is make sure when we're passing assets from one generation to the next is that we get a step up in basis. So there was no income tax paid. Well, they're talking about eliminating that step up. So what has this done? This has really put estate planning on the forefront. For instance, the way the law works, if you use your $11.5 million exemption now, and they change the law, and let's say the exemption goes down to $3 million, there's no clawback, meaning you used your 11.5, good for you, don't worry about it, life goes on. If you don't use it, that's a lost opportunity, okay? So something to keep in mind there. Trump's side of the equation, he hasn't said a whole lot about tax stuff, but he really wants to make the changes that took place in 2017, which was known as the Tax Cuts and Jobs Act, permanent. So keep rates down, certainly keep the exemption up. Point being here, as I mentioned, the exemption at $11.5 million is good through 2025. So depending on how this election goes, this exemption amount can change a lot sooner than that. And that's our forecast. If there is a Biden win, we would expect things to change. Now, given that we are in a, I would call it a recovery right now, we don't expect immediate tax law changes only because you don't want to burden people in a recovery. But if it didn't happen next year, it's certainly in our cards for 2022 and beyond. So point being, as I mentioned, you better look at your estate plans. Political risk is certainly highlighted this year. Many of the favorable tax planning opportunities could disappear. If you're in the gifting mood, I would certainly take full advantage of that $11.5 million exemption. Okay. One thing that in all the plans we've reviewed, portability, which is a way to move your exemption from one spouse to the next, is preserved so that we don't expect any change there. And again, if you use your exemption now, even though if you have to file a gift tax return, no problem, there's no clawback of that used exemption if the exemption amount, let's say, goes from $11.5 million down to, let's say, $3 or $3.5 million. Okay. And there are certain types of estate planning strategies that are very powerful in a low interest rate environment that we are in today. One of them being a grant or retained annuity trust is one idea. So in final thoughts, this is a great time to get together with your tax advisor, include John in those conversations around your income tax planning. Make sure that you're not paying any more tax than you have to. Basic tax planning is basically accelerating deductions and deferring income, though post-election, I may change that. Meaning if we saw a Biden victory, I'd be more inclined not only to accelerate my deductions into this year, because he's talking about reducing itemized deduction benefits on the wealthy to a fixed percentage. I believe I saw 28%. So if you happen to be in a higher tax bracket like 32 or 35 or 37, your itemized deductions are essentially going to get a haircut. So they're worth more now than they would be in the future, so I would accelerate them. Also, they're going to raise the top tax rate potentially as well from 37 to 39.6. I would look to increase my income this year as well. So this is a weird year if we get a Biden win that I would actually opt for both. Increase my income this year and my deductions. That's not normally what I would do, but given the election, that's something I would certainly consider. And with that, I am done.
Okay. All right, Dean, thank you very much. If you could, again, hang on maybe for the Q&A after David presents, really appreciate you doing that. Good presentation. One comment I would make real quick, Nicole stopped in. I guess we've gotten a few messages or emails, people that maybe can't view the slides. One quick fix for that, if you close out of the meeting, which means you'll be out for a minute, but then log back in, that is a potential fix to if you are having an issue with viewing the slides, which apparently we've had 3 or 4 calls or emails with that issue. Also, again, just repeat, this is being recorded. We will get the slides out to everybody, so I apologize if you can't see them now, but we will for sure get them out to everybody that participated. So with that, let me turn this over to David. A few years back, some of you may remember we had one of David's colleagues, Chuck Adler, speak at our client event. So it's been a few years since we've had an estate planning attorney present. I thought with COVID and some of the things that Dean kind of laid out at the end of his presentation, it was really timely to bring David on. You've got his whole bio there. I won't read that. I want to, just in the effort of time, get this over to him. He's going to talk some about planning strategies to be aware of in light of COVID. So, David, with that, I'll turn this over to you.
All right. Thank you, John. So yeah, jumping in here, we'll try to keep things, relatively concise here. I think the order of the speakers is probably appropriate in my experience in working with other advisors. Clients want to talk to people like John and Josh because they want to invest their money and grow their money and to build more assets, and then they want to talk to Dean about the tax planning, and then, oh yeah, I guess we do need to talk to the estate planning attorney from time to time to make sure that all of our affairs are in order here. And it's been a year unlike any other, as you've heard through all of the presentations and as you know from your own lived experience here. So we're going to walk through some of the concepts that Dean touched on, go in a little greater detail on some of them as well. Coming back to estate planning during this pandemic, I think it has opened a lot of people's minds to the conversation about estate planning and has encouraged people to be a little bit more aware of their own mortality and a little bit more thoughtful about, wow, there really are a lot of contingencies that could go wrong. And it's really underscored the way the COVID-19 virus plays out for people has really underscored the importance of lifetime planning. And do you have a plan in place for if you should be hospitalized or placed on a ventilator for a period of several days or weeks? Do you have the right people in place to be able to deal with your affairs going forward. So, financial power of attorney, a document allowing someone else to have clear legal authority to manage your assets, pay your bills, deal with your investment accounts. Do you have one of these documents in place at all would be question number one. If you do, question number two is how old is that document and does it actually name the right person? Often people will have done a full set of estate planning documents when their children were young and then maybe they just never get around to updating those things. Maybe you've named a family friend who you've lost touch with in the last 15 years. As an agent, and all of a sudden you're going to have some problems with that document. Also, financial institutions can tend to get a little bit cautious about documents that have been executed too long ago. I often find if a power of attorney is getting to be more than 8-10 years old, financial institutions start to ask a lot of questions about whether those documents are still valid. So be conscious of that. Be thinking about whether you want to update those. Another big issue that's come into play in the last few years, maybe you've got a lot of your accounts set up for auto bill pay. It would be very easy for your financial agent to just get in and manage things through your bank's online portal. But maybe they don't have the usernames and passwords to be able to get in there. Maybe your power of attorney was silent on the issue of whether they have the ability to access those kinds of digital accounts. That might be something that you want to address in a financial power of attorney going forward. State law recently enacted about 3 years ago does grant agents under powers of attorney a lot of authority in this area. But if you want them to be able to get in and access your private digital communications, that's something that you're going to need to be able to specify, in a financial power of attorney. And also, going to some of the points that Dean made, what about ability to access your digital medical records? Might be another thing that you want to deal with. My wife's father had a significant heart episode a little while ago and was actually in ICU for a little while. And my wife's a veterinarian, and she was lamenting dealing with the hospital and the human medical system where there's so much emphasis on information privacy. She couldn't get information about how her own father was doing, but she has clients, if she hasn't returned a call by 6 o'clock in the evening, who are just tremendously upset that they haven't gotten the full detailed picture of what's going on with their family dog. And so the information privacy can make things very challenging for your healthcare agent to deal with. So again, making sure that you have the right person in place there. If you have access to an online portal for your online medical records, maybe you want to give your healthcare power of attorney the ability to access that kind of information. Dean mentioned making sure it's clear that your agent can correspond through remote communications. Also, the healthcare power of attorney names, in addition to naming agents and making sure that the right agent is there, it also gives contact information for those agents. So is the contact information still up to date or not? You don't necessarily need to re-sign a new healthcare power of attorney. You can probably just cross it out and pencil in the right name, right contact information and initial it. But making sure all those things are up to date is key. Here in Ohio, we have 2 different healthcare directives, the healthcare power of attorney and the living will. The living will is the document that states your wishes concerning end-of-life care. Basically, by signing one, you're saying, if I'm in a terminal condition, permanently unconscious state, keep me comfortable, but let me go naturally. Don't do things that are just going to prolong my life, but not lead to recovery. With a COVID-19 situation, in the general course of things, being placed on a ventilator would be something that would be designed to lead to recovery. It's a temporary treatment needed to help you get through this disease, and there's no reason to believe that you wouldn't be able to recover fully if you had that temporary treatment. So in the normal course, most of the living wills forms here in Ohio aren't going to prohibit you from being placed on a ventilator, but many people do include special instructions saying, no, I wouldn't want to be placed on a ventilator, and that type of thing that Dean discussed. That really could make a difference. So if you did sign one of these documents long ago and you don't really remember what you said, it would be a good time to blow the dust off of that document and figure out if it's still appropriate to the current life situation that we're all living through. And of course, then there's the actual practical reality of how do I actually sign any of these documents? How do you sign a will here in Ohio? State law requires that you need to sign a will in the conscious presence of two witnesses, and that conscious presence can't be enhanced through electronic communication. So the idea, basically the distinction in state law is if someone was in a hospital room and the witnesses were looking through a window, they could watch the person sign it, and then the will could be brought out, and then the witnesses could sign it there outside of the room because they have seen with their own eyes directly through the window. But if we're talking about a Zoom meeting or something like that, not going to be permitted. You can't witness a will in Ohio through a video conference, and so we've been needing to get creative this year about what people are comfortable doing or not doing in terms of signing their estate plan documents. I think my first signing meeting back in April after the pandemic began, I was meeting with the clients and we were out in their garage with the garage door open and we were signing their documents on the trunk of their car. We've had attorneys who have hosted signing meetings outdoors at their own homes, meetings in parks, a variety of different things that we've done, but we do need to actually be in person to sign a will to get those two witnesses here in Ohio. Other types of legal documents, Ohio is allowing electronic notarization. You can find someone who is certified that way. If you look hard enough, that's not a certification that goes with all notaries. So just because you know someone is a notary, that doesn't mean that it's valid for them to notarize a document in an electronic manner unless they've actually gone through the special certification for that. And I know at least among attorneys, it's relatively few of us who have chosen to pursue that certification due to the pretty burdensome requirements of maintaining records and recordings of the video notarization ceremonies themselves. Dean gave us a nice overview of where we are on the current and future state of the estate tax law, so I'm not really going to reiterate that all that much right now, other than to say we currently have a very large exemption at $11.58 million, as he mentioned, and that's per person, $23 million for the couple. That's because that base $5 million amount that's been adjusted for inflation got doubled to $10 million in 2017. In 2026, it's scheduled to go back to the 5, probably get us up to $6 million with the inflation adjustment. So we're looking at what's built into current law. If you're under $12 million as a couple, you're probably going to be fine from an estate tax perspective. It's been a little unclear to me whether Vice President Biden's proposals have been returning the exemption to $5 million, that same base, or going all the way back to the 2009 rules of $3.5 million, as Dean mentioned earlier. But we could be looking at a significant reduction in that exemption amount in 2021 or 2022 as we look at it going forward. So what are we doing if we have this increased estate tax exemption? Many of our clients here in Ohio can actually use this as an opportunity to simplify their plan. A lot of clients, married couples, set up what we call AB trusts or credit shelter trusts back in times before 2013 in order to double the estate tax exemption as a married couple and be able to pass twice that amount down to the next generation estate tax free. This was particularly important because up until January 1 of 2013 in Ohio, we had our own state-level estate tax that kicked in at an exemption amount of $338,333. It was the lowest exemption in the country. And so if you were a couple, you had $2 million back in 2009, almost certainly your estate planning attorney was saying for estate tax planning purposes, you need to have an AB trust in place to preserve that estate tax exemption amount. And so you did that planning in 2009 because it was good advice then. You've been working with the Parkhursts for a while now, and they've grown that $2 million over the last 10 years, so now it's $4 million. Well, you come and talk to me, I'm going to tell you that estate tax planning that you're doing there is probably unnecessary as a part of your estate plan, and you can probably simplify the plan now. Because in addition to the repeal of the Ohio estate tax, we've brought in this concept called portability into the federal estate tax law, which basically the estate tax is designed to tax transfers from one generation to the next. And leaving property to your surviving spouse, you're generally considered to be kind of the same economic unit. So if you leave your property outright to your surviving spouse, you get a deduction for that for estate tax purposes. Portability basically says, okay, if you left everything outright to your surviving spouse, you didn't use any of your estate tax exemption because you got a full deduction there. And then we're going to allow the surviving spouse to basically inherit that estate tax exemption by filing an estate tax return on your behalf. And now the surviving spouse will have double the estate tax exemption. And so through that kind of a process this year, if you had that kind of a plan in place right now, after the first spouse's death, the surviving spouse would have an estate tax exemption of $23 million, north of $23 million in their own right, without needing to do any of the trust planning that we've discussed. So we've been taking a lot of the estate plans that we're doing that credit shelter type of planning, basically simplifying, leaving outright gifts to the surviving spouse. Occasionally, we're still maintaining that trust for the surviving spouse for control issues. Maybe they're children from a prior marriage. We want to make sure they're protected from the spouse disinheriting them. But for tax planning purposes, we're often eliminating that trust for the surviving spouse for folks who are net worth of $5 million or below. But even as we eliminate those trusts for the surviving spouses, we are still continuing to use trusts fairly regularly for the descendants. Variety of advantages there. There are some estate tax advantages to that, but often we don't care about that in these settings because the exemptions are so high. But we're still concerned about who's going to manage those assets for the benefit of the minor children or young adults until they're mature enough to handle it themselves. And then we're also concerned about creditor protection, whether that's a child making poor financial decisions, whether that's a child who gets into an accident and suddenly has a significant liability exposure, or the creditor that many people tend to be most concerned about, the divorcing spouse. Property left inside that trust wrapper for the benefit of the children is going to be better protected from all of those circumstances than if you just gave your child an outright gift of his or her inheritance. One also thing I do want to mention relating to the Secure Act and the implications for planning at death. If you have significant assets in IRA or 401k type of plans, the old rule before the Secure Act was that you could leave those to your children. Children could take distributions out of those accounts over their remaining life expectancy and continue to enjoy the benefit of that income tax deferral for maybe 30, 40, 50 years, depending on their ages at the time they inherited those assets. As a part of some of the deferral of required minimum distributions and increasing those ages that was part of the Secure Act, the government needed to raise some revenue somewhere else, and they decided, why are we giving these retirement benefits such favorable tax treatment in the hands of the heirs? We want people to save for their own retirement, but we don't necessarily want to generate retirement plans for the kids to the same extent. So what they've done is, in the vast majority of cases, they've shortened that distribution period for children or other non-spouse beneficiaries to be only a 10-year window, which means you're going to be taking out more each year, which is going to subject more to tax quicker. And then that's also more often going to come out in the very high income tax, high earning years for the adult children. And so the government's going to be getting an even bigger cut there as well. So if you're thinking about including charitable planning in your testamentary plan, in the giving that you want to do at death, even more so these days, using your 401k or your IRA to fund those charitable gifts at death is going to be a really good planning strategy. Taking advantage of the large current exemptions, one of the ways that we're doing that is by making taxable gifts now, and Dean kind of touched on this as well. what happens is when you calculate the estate tax, you basically add back in the gifts that were made during lifetime and the transfers that are happening at death, and then apply the exemption to the whole thing. And the estate tax exemption has steadily increased over, in fits and starts, but it's never gone back down since the year 1934. So we don't have a whole lot of precedent for what happens if you made a large gift when the exemption was high, and now when you die, the exemption is smaller. What exemption have you used or not, and are you going to wind up paying additional estate tax relating to assets that you gave away during lifetime? And Dean referenced the concept of clawback, and that there would be no clawback, and that this is the issue that's being talked about there. So you assume Alice gives away $11 million this year. At her death, the estate tax exemption has gone back to $6 million. She's not going to be assessed an estate tax based on that extra $5 million of tax-free gifts that she made during her lifetime. That's not going to get clawed back into her taxable estate. So making that gift now, taking advantage of that exemption, you get it even if the exemption goes away. Suppose Bill, on the other hand, gives $2 million to his kids this year when the exemption is north of $11 million, and at his death the exemption is only $6 million. He didn't give away $2 million of the extra. He gave away $2 million from the bottom. So at his death, he's only going to have an estate tax exemption of $4 million to apply to those gifts. And so if you are in a situation where you're going to be, where you have the ability to make a substantial lifetime gift, to lock in that gift tax exemption right now, certainly there are a lot of people who are in that level who are thinking this may be the year to try to make that kind of gift. How do you do it? One, in order to really lock in that extra exemption, you need to make a gift that's above whatever the estate tax exemption is at your death, which we think maybe $6 million is going to be the new baseline going forward, but who knows? Could be all the way down to $3.5 million. So you need to give more than that amount. The easiest way to do that is just give it to someone. Give it to your children outright. Put it in their pocket. But you can further leverage it by making it into a trust for the benefit of your children. The trust is then going to give it that asset protection that we talked about. You can allocate your generation skipping transfer tax exemption to that gift, which will allow it to continue to avoid estate tax at your children's death, at your grandchildren's death, as long as it stays inside that trust wrapper. You can even make the trust what we call a grantor trust for income tax purposes, which means the trust's income is going to be reported on your own income tax return, and you're paying that income tax on behalf of the trust isn't a gift yourself. It isn't counted as an additional taxable gift against your gift tax exemption. For those who feel like they don't have the resources to be able to confidently give away all of that property down to the next generation, a lot of folks are looking at what we call a spousal lifetime access trust, or a SLAT, which also allows the spouse to be a beneficiary if needed. Generally, you're going to want to allocate generation skipping exemption to this kind of trust, so it would really be a last resort to pull that money back out for the spouse. But it could be available there as a last resort if you're feeling a little more cautious about how much you could afford to give away. Basically, by making a SLAT, what you're doing is you're creating that estate tax exemption credit shelter trust during your lifetime. And with any of these kinds of situations where you're considering making these really sizable gifts, it's always important to talk with your advisor first to determine your gifting capacity. And with that, I will turn it back over to your advisor.
Great presentation, and I know just from looking at the participant list, there's we have some mutual clients that are participating on this. Many of you have used David and his firm in the past, and certainly for those of you that may need some planning help, that's something we can talk about. They've done a great job with a number of our clients over the years. So let me just, in the effort of time, that we've had a couple questions come through. So I'm going to kind of we'll go through those, and then we'll kind of do the wrap up. But David, one thing, let me just throw one to you. I know you mentioned some larger gifts with your examples. One question I get a lot is surrounding the annual gift exclusion, the $15,000. Can you maybe just speak to that and just kind of how that works for whether it's a single person or a married couple? what they're allowed to do with that.
Yeah, absolutely. So and gift tax language gets complicated because we have the exclusion and we have the exemption. So the annual exclusion is a really powerful tool if used regularly by clients. So every person can give away up to $15,000 per recipient every year to as many recipients as they want, at least right now. I think there's been some talk of reining this in too. So as a married couple, you could give away $30,000 to as many people as you want. Suppose a couple who has 2 adult children, they're each married, and each of them has 2 children of their own. So the grandparents could give away $30,000 to each of the 2 children, the 2 children's spouses, and all 4 of the grandkids. So that's 8 times 30,000. That's $240,000 that they could give away, and it's not reported to the IRS at all. It's under that threshold. The IRS doesn't even need to care about it. Once you get above that $15,000 to any person in any year, then that's when you're using your lifetime exemption amount, that $11.5 million that we talked about. But yeah, if you're in a situation like that, you could give away easily, in the right family circumstances, $200,000 a year and really drive down your taxable estate without any tax consequence.
Okay, great. And then when you get above that is when the tax form or tax return may have to be filed, correct?
Correct. And that's a gift tax return. That's IRS Form 709. Generally due at the same time as your income tax return, but it's not an exhibit to your income tax return. It's a separate form.
Okay, gotcha. Perfect. Okay, great. One other question that came in, and Josh, this may be for you or possibly Dean, but Josh, I'll throw this to you. A question came in. You mentioned, I think, some earnings projections, maybe referring to the PE. The question is, how will S&P earnings projections for 2021 be affected by the election in 3 weeks? In other words, are you guys making any changes, or J.P. Morgan, or will that have to be wait and see how the election turns out first?
So it's a good question. I'd say that the key element, again, that I would go back to is just the idea that we anticipate that more fiscal support will be there. And as you continue to see economies open up, then that's going to be kind of the underlying components that spurs economic activity. So that is sort of the most critical piece in our mind, and that's there in either direction that you go with the election in terms of a re-election or Vice President Biden being elected into the White House. I'd say under the hood from there, when you think about some of the sector aspects, and this was alluded to in some of the comments this afternoon, there is an anticipation that when it comes to a Biden presidency, potentially that you would see an increase in corporate taxes, but then also potential for higher taxes more broadly, right? And when you think about corporations, this last administration here, or the current administration, we saw the reduction in the corporate tax rate. That was a boon for corporations. And, a move in the other direction, all else the same, would not be advantageous. The caveat to that, though, is that I would say that our belief is that would be counterbalanced by the idea that you would see more spending in other areas. So, for instance, and even in the last few days, you've seen, some projection, some belief that there's a greater likelihood than there was a couple weeks ago or in recent months that you'd see Democratic control across the board in government. And one of the elements that's been talked about is the idea that you would see greater infrastructure spending, right? An infrastructure bill that would have the ability to get passed through the government, but then also be more sizable than what it would be otherwise, right? So you have this idea of higher corporate taxes potentially balanced out by the idea that you would see greater levels of spending potentially, in a Biden administration. I would also say that one of the other things that we've talked about a bit, is the idea that because you're living in a global pandemic, or we're living in a global pandemic right now, some of the things that are kind of hot button issues for a lot of people and come up in conversations here in the last couple of years in terms of where focus would be, perhaps those take a little bit more of a back burner type of position relative to just getting the economy back online, right? So, the idea of a corporate tax hike being the first priority, we think isn't likely to be the case. Even if you see a Biden administration. So we don't think that that's a 2021 issue or a 2021 conversation. We think that's more 2022 and onwards if we do see that come through. Sorry, this is probably the longest answer and longer than you would. Maybe one last thing is I would just say that there is also this idea that if you look at technology companies, for instance, healthcare, given that that's certainly been a number of the conversation points within some of the debate back and forth and just differences in view, those could certainly have implications. I wouldn't say that changed the overall story, though, of we anticipate this 12, 18-month period moving forward is a supportive environment for equities and stocks generally.
Okay, good. I think it's a great answer because I think sometimes the natural thought is, well, taxes go up, your earnings go down, right? So companies are going to make less money if they're taxed more. But that's, I think, as you laid out, A, that may not be immediate, depending upon who wins the White House, and then B, it may be more of a, and with the fiscal support may offset some of that. But let me ask, I'm going to do one last question, and we'll wrap up that I've been getting to. I think briefly you mentioned, Josh, interest rates at low levels. People understand the relationship. Interest rates go down, bond prices go up, interest rates start to go up. That could put pressure on bond prices. So a lot of times as we set up portfolios, we recommend having an allocation to bonds or some type of fixed income, which people view as a safer haven versus stocks. But could you give just brief thoughts on where interest rates may be headed? It can't really go much lower, and maybe just a potential outlook for bonds and fixed income the next year or two.
Sure. Yeah, sure. So our base case view, where we are kind of orienting ourselves in terms of allocating portfolios is a belief that we are in this early setup for a new business cycle, right? We've kind of had the very, very tough period, and now we're on this upswing, right? And if you're on this upswing and you're seeing the type of policy support, if you're seeing the type of accommodation that policymakers are really throwing into the mix, all of that effort is to spur economic activity, and with that, you should see what we would refer to as kind of a reflationary environment, right? And the ability for interest rates to incrementally move a little bit higher from here. So that is kind of the view that we're taking within our team. The ... to that, though, is we would not anticipate that interest rates are shooting higher markedly overnight, right? This is something that will play out over time. If anything, you've seen this kind of 40-year, grind lower, move lower in interest rates. And, when you look at the amount of debt that you see governments, holding today, whether it's here in the U.S. or outside the U.S., at the end of the day, you need, fairly low levels of interest rates for them to be able to finance that debt moving forward. Right, so what we're trying to do in portfolios is think about how you diversify your fixed income allocation, and we're certainly cognizant of the idea that you perhaps don't get as much protection as what you've historically gotten in very high quality bonds, so things like government bonds. That said, John, to your point, they certainly still act as a part of that shock absorber in a portfolio during periods of stress. It is thinking about how you complement them as opposed to selling out of that entire allocation in general.
Great. Thank you. Thanks, Josh. Appreciate it. Let me move off here to just take a minute to wrap up. I want to thank everybody. First of all, thank Josh and David and Dean for taking the time to participate today and putting together the presentations. I thought all three were outstanding, very well done, very, very timely. So I really appreciate all three of you and your support and your time. Again, I want to thank SEI for hosting this and their technology. If anybody had any technical issues out there listening or viewing, I certainly apologize. Again, we are recording this, and we will have the slides and the recording available. It's a different year, so for us, we had to try something different. I want to make sure I thank Angel, Nicole, Diane here in the office, who all helped coordinate this, get the invitations, and get everything together. Particularly Angel probably spent the most time on it, so really appreciate all her help with this. And again, just want to thank you for attending. Everybody that participated, it looked like we had a pretty good turnout. Which is great. Hopefully next year we will be back in person with a live event. That's certainly our plan and hope and intention. We'll have to see how things play out, but hopefully that's our plan. So again, just thank you again to everybody for attending, and have a great rest of the day. So thank you. Bye-bye.